Hello, my name is Amelia, and today we're going to talk about behavioral finance using the Bonaparte Behavioral Finance website as our guide. So, first, let me start with a quick thought experiment. Imagine I offer you a coin flip. Heads, you win $100. Tails, you lose $100. Fair, right? Well, actually, most people will say no. Here's the strange part. For a lot of us, that coin flip only starts to feel worth it when the win jumps to about $225 against that same $100 loss. The pain of losing 100 is roughly the same size as the joy of winning 225. So in our heads, we're not really weighing this evenly. And that tiny imbalance quietly shapes almost every money decision you'll ever make. Now, standard finance assumes that we're all perfectly rational creatures, that markets are efficient and prices always reflect the truth. Behavioral finance says, have you actually met a human? Oh, okay, so let's just dive in with this overview. Standard finance pictures the investor as Homo economicus, a flawless, rational agent. Behavioral finance replaces that with Homo sapiens, you and me, running on mental shortcuts, emotions, and the occasional bad night's sleep. So the textbook says markets are efficient and priced fairly. Behavioral view says prices often get distorted by feelings and peer pressure. So, here, if you look at the different descriptions of market anomalies, you'll see that there are patterns that shouldn't really exist if markets were truly efficient, but stubbornly they do. I mean, winners keep winning for months, a pattern called momentum. Cheap, boring stocks quietly beat exciting, glamorous stocks over time, the value premium. Small stocks pop in January like clockwork, and closed end funds trade for less than the assets inside them, which is a bit like a wallet selling for less than the cash it holds. These are fingerprints of human behavior showing up in the data. Moving on to the next screen is bias versus irrationality. Now, this section clears up a distinction that trips up a lot of people. A bias isn't random sloppiness, it's a systematic error that leans the same direction every single time. That predictability is actually good because you can't design around random mistakes, but you can build systems around consistent ones. This site frames all of this with Daniel Kahneman's famous two systems. System one is your fast brain, automatic, emotional, always on. It's the voice that says, this stock feels like a winner, or everyone's buying, so it must be good. System two is your slow brain, deliberate, analytical, and honestly, it's a little bit lazy. It's what you use to actually read an annual report or run the numbers. The whole tragedy of investing is that system one reacts to a price drop instantly, while system two is still getting out of bed. As you scroll down, you'll meet giants behind the field. Kahneman gave us prospect theory and those two systems up top. Richard Thaler shows that tiny tweaks to how choices are set up produce huge changes in behavior. Robert Shiller showed that asset prices swing far more wildly than any rational model predicts. The timeline traces in 1952 Markowitz all the way to behavioral finance shaping real government policy today. One idea worth noting here is adaptive markets hypothesis. The argument is that our biases aren't bugs, they're old survival features running in the wrong environment. Loss aversion made perfect sense when a lost food supply meant starvation. Herding made sense when running with the group meant not getting eaten. The same instinct that saved your ancestors and my ancestors on the savannah is the one that makes you panic sell at the bottom of a crash. All right, so now let's move on to anchoring and framing. So here we get hands on. The site runs a live experiment, and I want you to actually play along, okay? Under the first part, it flashes a totally random number and then asks you to guess the population of Chicago in the millions. This number right here has nothing to do with Chicago, but watch. When you type your answer, notice how your brain quietly drifted upward toward that big irrelevant number. That's called anchoring. So let's just say, I don't know, 100 million. Bam. The actual population is 2.7 million. Here, part two makes it financial. So it tells you a 52-week high is $151, and it currently trades at $82. They are asking for a fair value estimate for this stock. Notice how you're feeling. Notice what you want to do, because this actually has nothing to do with where the company is actually worth today, but it does pull your estimate up anyways. So let's just put, I don't know, 90. All right. So this basically tells you that real investors usually refuse to sell stock below what they paid for. They're anchored to their own purchase price, a number the market could not care less about. All right. So this kind of tells you the explanation of what just happened. And then down here is the framing effect. Here are same facts, except it's expressed in different packaging and different decisions. Choose a program. Which one would you choose? Program A or program B? I mean, 72% will choose the first option just on how it's phrased alone. All right. So moving on to herding and bubbles. So if you scroll down here, you'll see the bubble simulator. Here you start with $10,000 in cash and a handful of shares. The asset pays a dividend, so you actually know its true fundamental value. It's right here, $100. Then the market opens, everyone starts trading, and you watch the price float away from that $100 anchor of truth. So go ahead and play this. There's 1 out of 15 rounds. Notice how you're feeling, because that's the whole lesson. Even knowing the real value, it is hard not to buy as the price rockets up and everyone around you seems to be getting rich. So that pull is called herding, and the fear of missing out is on the driver's seat. So some of the historical bubbles in the past. In 1637, the tulip mania was up almost 6,000% before collapsing 99%. The dot-com crash, the housing bubble, Bitcoin, GameStop, different centuries and different assets have the same exact 5-act play: displacement, boom, euphoria, profit taking, and panic. Schiller called bubbles naturally occurring Ponzi schemes where no fraud is required. Moving on to loss aversion. Remember that coin flip from the very beginning? This tab measures it for you personally. Just answer these 8 quick gambles, and at the end, it will give you an output of your lambda, your personal loss aversion coefficient. For most people, it lands around 2.25. And let's just see. I mean, I'm just going to go at this really, really randomly, just so that you can kind of see. All right, so my lambda score is 1.2 when I fill this out randomly. This value function graph ties everything together. This shape is something worth noting. The curve on the lost side is steeper than the curve on the gain side. So it kind of explains a little bit about market behavior. So moving on to investor behavior. This section turns the mirror on your actual habits. The portfolio autopsy here asks how often you check your accounts, what do you do when stocks drop 20%, how many individual stocks you own, et cetera, et cetera. Then it scores you across 4 biases and estimates what they're costing you per year. So let's just kind of go through this. I mean, again, I'm just going to go ahead and fill this out pretty randomly, but when you go through this, I'd like you to answer honestly. So you can see that it gives me results. All right. So if we're all this predictable, can we design around it? That's Richard Thaler's Nobel winning answer. This simulator lets you play policymaker. You toggle behavioral interventions over here on retirement plan and watch the predicted numbers move in real time. So, like for example, if you hit automatic enrollment, you'll see participation rate go up. Go around and play with this just to kind of see how the numbers for predicted outcome change. Moving on to the bias self-assessment. There's 20 questions that measures you across 6 biases, and it plots your result on a radar chart. Then it names your dominant bias and gives you specific actions to counter it. That's basically it. So, I mean, let's go ahead and just. There's your radar chart, and here's your behavioral profile and your personalized action plan. And that's it. Behavioral finance is really about recognizing that these patterns live inside all of us and then building simple systems like checklists, default rules, and diversification that let your slow, wise brain overrule your fast, panicky one before it does any damage. Thanks for watching, and until next time.